When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines. Then we'll discuss ways to lower your risk in retirement without giving up reasonable returns. We'll answer listener questions and then finally gifting while you're alive and kicking. My name is Jeff Shea. As always, I am just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Hope everybody's having a great weekend. We appreciate you listening every week on 790 KNST. Jeff, let's talk about the market and the economy here, current event headlines. Of course, we're in the month of November at this point in time. What can we traditionally look for in November, and is this November any different?
Actually, I think this November is a lot different. We had, typically September and October are the months that we always worry about the stock market crashing. Historically, that's always been the time that it does. You can also look at certain trends in the market that typically between May and November, it's kind of flat to down. Well, May through September and even October, we had a pretty good market run, good bull run. We had just atypical things happen. And now, of course, we know that back in March and April, we were worried about the tariffs and the market sold off and got a little crazy, and then Trump said, no, never mind. We're just negotiating. It's not really going to happen, and put those things on hold, and the market rallied back pretty quickly. It's amazing how fast money gets back into the market because of all the liquidity that the rich people and the traders and the market makers have. Unfortunately, a lot of the Main Street investors don't have that much money, but they're thankfully able to ride the wave if the wave is good. What I'm seeing lately, which I haven't seen, and one of the things that has made the market rally, gold, silver, production for precious metals, all the AI hype, which has been quoted as overhype, has really driven this rally in the market. So is AI really going to be as big as they say it is? They thought the dot-coms were going to be bigger than it ever was, and it wasn't as big as they said it was. Even though it was big, it's huge, and it's been huge for 25 years since the crash in 2000. However, it was basically overplayed, overhyped, and a lot of people lost a lot of money. AI is very much the same thing, in my opinion. We go through these different phases throughout the market life and the market cycles. We did have something that wasn't technical involved that was a hype, and that was where you could box up mortgages, good, bad, or ugly, and call them good mortgages and sell them as a package, as a security, and they securitized the mortgage business, which ended up making the bank crisis happen in 2008, where we had another 50% or more market crash in the Dow and the S&P. We had that also in the year 2000. We've had some mini crashes. We had 2018 was a sell-off due to liquidity issues in the banks, and that happened late in the year, about the November, December timeframe, just like we're going into. So that was kind of an anomaly, since typically the flat to bad months end in October, and November is typically a very good month. And the reason November is typically a very good month is because it's usually bouncing off a low or a crash or a correction that happened in September or October, if you look at the histories and you try to average everything out. But we also have seen, two different trends happen at the end of the year. One is what we call window dressing, where companies will do stock buybacks and pump their own stock so that they can have a good year. And because everybody looks at the calendar year and say, oh, look at this stock did good, this company's doing great, and look at their annual returns. Mutual fund companies do the same thing. They try to buy up certain stocks that can drive their fund price. Sometimes they overbuy in order to kind of trick the market into thinking that the stock should be that high in value. But the market makers in general, and that includes mutual fund companies like Vanguard, Invesco, Fidelity, and those guys, and all mutual fund companies, those companies just happen to have trillions of dollars in mutual funds, not billions. And so with their buying power, they're able to drive the markets. And typically they like to do what we call window dressing at the end of the year. The problem is there can be sometimes some credit crunches or liquidity crunches where the Fed doesn't have really the ability or not in a position to start printing money, which they have done in the past to prop the banks up. What we've seen lately during this rally is we've seen the dollar weaken over the last 6 months or so, which actually makes things like crypto more attractive, gold and silver more attractive. It makes our market actually a little bit more, seem to drive the health of the market. Everybody complains, oh, the dollar's going down, but it's largely responsible for the rally if you want to really look at it and how it plays into the financial picture. What we have seen in the last few months or a few weeks is the dollar starting to strengthen rather. And as the dollar strengthens, people are less interested in gold and silver. So we've seen gold and silver and even the mining companies sell off thinking that, oh, well, maybe the rally's over. Maybe we're not going to have $4,000 or $5,000 or $10,000 gold. And the reason that it was projected to go there is because they're thinking because we printed so many dollars, the dollar's going to be weak. It's going to stay weak. It's going to be forever weak. The dollar is only weak compared to other currencies. And often it's because it's being manipulated. The other thing with a weak dollar, it also affects the bond market. It affects the price of credit. There's a few other things. You're talking about why we think November could be a typical November, which is, if you look at averages, a very good month, or why we need to be a little hesitant and maybe a little worried this month, which is kind of the way I'm leaning. And that is there's been some recent action in the Fed. Typically, when the Fed lowers interest rates, it's kind of more or less capitulation saying the economy is really not that good. We need to lower interest rates to stimulate buying, to stimulate the economy. We are at an all-time high for credit defaults, for housing repos, for car repos, for housing defaults, mortgage defaults, loan defaults in general, the highest defaults on credit cards and the highest credit balances ever on credit cards. The other thing we have a high credit balance on is the stock market. What I mean by that is there are margin accounts. That's well over $1 trillion. In fact, I believe last week it exceeded the prior high, which I think was right after COVID, if I'm not mistaken. When everybody got into a feeding frenzy, everybody's sent home, couldn't work. So everybody became a day trader and borrowed money against their accounts. And then it kind of waned off a little bit and people were a little bit more sensible, a little bit more cautious, especially after the 22 crash, which wasn't really a crash, it was a correction that was, again, saved by printing money, which is inflationary in nature. So we've got all this money printed out there. It's been driving the market up. It's been overvalued to a level that we really haven't seen before, or only seen even close to twice, and that was right before the 29 crash in 1929, the Great Depression. And then we also had it in the dot-com bubble that burst, and we're valuation-wise, we're at those highs. And some people say, yeah, so what? Oh, well, it's valued high. You can say that, but every time they've said that, yeah, so what? This is different. The market's different. It's different this time. The most dangerous words in basically market investing is it's different this time, because it never is. When it gets overvalued, values tend to, so far, have always returned to a more normalized or more average 100-year average range, which would be less than half of where the market is right now. So we've got all these fake earnings, AI companies projecting all these earnings outward down the road. They project earnings. They have a lot of pre-sales because everybody's trying to get on the hype and make deals, and they book sales that really may or may not even happen as sales. And then they've got these receivables that may or may not even be received. And somehow it makes the balance sheets look good. It makes the earnings look good. And then when the earnings come in, they lower the estimates so that they can always come in with a beat. 80% of companies just these last few weeks during earnings season for the third quarter of this year have beaten their estimates, their revenues. However, we had one which was so overvalued, it's not even funny, a company called Palantir earlier this week that said, well, our earnings didn't come in quite as good as we had hoped. And the thing that bothers me about that is this trades at a price earnings ratio of 433. In other words, their earnings are like 44 cents a year. If you look at earnings up to right now, that's the 44 cents per year is they're making on a stock that trades at just under $200. So 44 cents on 200. I mean, that doesn't make any sense at all. I mean, there should be $8 or $10 worth of earnings to make that type of a stock justifiable, unless it's really growing at 100 or 200% per year. And the sales have been growing because they're mostly government contracts and they're getting a lot of them. But I don't know how long the government is going to continue to do that, because many of these contracts were done before Trump came in and before DOGE started looking at excessive spending. Now, I don't think that having AI security and some of the things that Palantir Technologies is all about, AI, they did do a lot of security for the government, military, defense, and things like that. They came in just shy of what was expected, which was almost nothing and nowhere near justifiable to where it is. And all of a sudden, now they're saying the market's getting soft. This week, we've seen some real softness and some sell-off in the market, especially in the AI space, because people are worried, like, oh my gosh, if Palantir can't keep making money, and they're already trading at like probably 10 times what they should be. And if they can't make money, then maybe all these other companies are kind of overhyped. And I think people are finally getting a little bit worried. Well, here's what happens when people get worried. They start selling and they have a ton of margin, meaning they've borrowed money against their stock in order to buy more stock. So they get worried about their margin accounts, or the stock goes down, and then they have to sell in order to pay their margin account back, because Wall Street community, who actually loans you money against your portfolio so you can buy more and drive the prices up, is really happy when the market goes down, they can say, hey, we have to force you to sell because we want our money back. And by and large, what happens is the market continues to sell off until margin gets under control, or people start selling short because it's going down. And so it exacerbates the downtrend. All the while, the Wall Street market makers are waiting to buy back in at a lower rate. We've seen unprecedented insider selling the last few months, meaning the CEOs of companies. I just looked at a stock that I was considered purchasing for our portfolio just yesterday. And it was interesting. There was, in the last quarter, about 30 insider sales, anywhere ranging from about $18,000 for a sale up to millions and more of stock being sold. And there was only 2 buys, and the buys were for maybe $10,000 of stock each. So the insiders, the people that own the companies, are buying at just a minuscule rate compared to how much they're selling. And this is a very popular big company that has been touted as having a lot of upside, just like some of these AI companies. So what I'm seeing is the hype is maybe overextended. It was overextended during a time when the market is typically not up. So now you go into the period where November to May, everything is usually rosy, and that's when most of the money is made historically in the stock market. Yet I think because we've been so overvalued and because the economic indicators that I continue to talk about are looking worse and worse and have been for the last 35, 40 months, it's almost 3 years, have not been getting better, they've been getting worse. And what that means to me is we're just like stretching a rubber band and it's going to snap. And it really does. The market's not going to care as much as Trump doesn't want the economy to fail or look like the economy fails, even though the stock market and the economy are two different things. If the market's good, presidents always like to take credit for it and make everybody think that they're doing a great job because the market's doing a great job. What that really means is probably the Fed's printing too much money and they have too much liquidity. But they're not having that liquidity. And here's another problem. And I'm full of all kinds of data this week because I'm really concerned about the softness and the selling off of the market. And I've been diving into it. But 2 Fridays ago, not this past Friday or the Friday before, apparently the banks were suffering some liquidity issues because of all the defaults and the repo. And there was a thing we call the repo fund, just kind of as a slang number, which is really when the Fed basically provides money to banks when they have defaults and aren't collecting the money that they're expecting. And there was a $50 billion repo payment apparently from the Fed to banks because of credit card defaults, housing defaults, car defaults, basically the repo fund. Again, it's a kind of a slang term. I don't believe it has an acronym that means anything. But bottom line is the Fed's basically having to cough up money to save the banks. The other thing that hasn't been noted is, and this has been on the books for a long time, there's at least $500 billion of bad debt, bad notes that banks are not collecting interest or even in principal payments back. So rather than writing them off as a loss, they can set aside unrealized losses as long as they don't sell the debt. They only have to declare them as losses if they actually unload the debt, which they would probably have to unload at a fraction of the price and actually turn in those 500 billion or more, probably closer to $1 trillion in losses spread out over the bank. So they would look insolvent, they would look scared, and then the banks would probably sell off, stocks would probably sell off, and that would probably be the start of a really good market correction or crash, in my opinion. Just like the 29 crash was largely bank-driven, and so was the one in 2008. It was bank-driven. They faked us out with money that wasn't really money, making money out of thin air and calling it money, and they're kind of doing that again by the way that they're allowed to keep their books. And then they get Fed money, like this repo fund money, and rather than pay off their debts or pay their bills with it, they basically buy up their own stock with it to drive their stock prices and make their company look even better. Of course, it helps their own treasury stock. They can unload some of that and make some money. But the last few years, most of the gains banks have made are manipulating the stock market, stock buybacks, not declaring actual losses and calling them unrealized losses or unrealized gains. Somehow the banks are allowed to keep their books different than any other industry, and that's because of the Fed involvement. It's because of all the powers that be, the Vanderbilts, Rockefellers, and Kennedys, and all the big money people, the Davos cabal people, basically started this Fed in order to make banks look good, regardless of whether they were or not, and always have a place that they could create liquidity and basically own the world financially. And that's really what the Fed does. Fed does not stand for federal government, as in a government agency. The Fed is actually a private agency. The government gets to assign people that are hopefully good at economics and banking and finance to positions in different districts so that they can, put their heads together. And then they have a chairman that speaks about, whether or not they should raise or lower interest rates. And typically it's reactionary. So it always comes in late, just like they're lowering interest rates now. I think it's reactionary. Should have been probably lowered because the economy really wasn't on strong footing before. But the thing is they've been printing money and creating so much liquidity in the market, and the brokerage houses have been creating so much extra money in the market, trillions of dollars, more than $1 trillion. I think it's 1.4 or something. It's over $1 trillion of margin debt that's available to be available to people just to trade extra stocks and drive the price of the market up. So again, I think we've seen a lot of fake economy. We've seen a lot of hype. This isn't the first time we've seen it. Can a lot of people make money? Yeah, if you get out at the right time. I mean, some people say, well, you never take a loss until you sell. Well, you also never get a profit till you sell. So it does work both ways. Just because the market was up and it's down doesn't really mean anything until you take profits and set them aside, lock them in, and keep them aside for your rainy days, for your income, or whatever you need. So anyway, I've said a lot of things. There's a lot of things that worry me. One more thing that worries me is my son, Taylor, who just joined our firm a few months ago. CPA, he's managed portfolios in the billions in real estate portfolios for huge banks and family businesses. And he also has some side hustles where he does books and analysis for some smaller lenders and private home flippers. Some of these investors have maybe, 10 to 100 homes. They're building portfolios, and some of them have not been able to sell their fix and flips. He also noticed that the only place that they're getting deals, and they're getting a ton of deals, is at the auction houses, basically on the steps of the courthouse, where they're getting foreclosures again. And here's the interesting thing, is it used to be that people would bid those up because they knew they could fix them and flip them, or they knew they could get them at a cheap price and sell it quick. And there was always so much liquidity and money in the real estate investor market, the private investor market locally. This is just Arizona stuff that I'm talking about. He says there's almost no competition at those courthouses on those sales. There's no competition. Either nobody has money, or they've got all their money tied up, or they're out of business. A lot of these fix and flippers aren't able to do it anymore. They basically lost everything on their last houses that have decreased by 20%, and that was their entire margin. So they've got to sell at break even and, say, well, glad we made a good living for the last 10 years. I got to go find a job. Or they've got to turn them all into rentals. Hopefully they can keep them rented and keep some cash flow going until the market gets good enough, or they pay down those mortgages enough to where they actually have equity again. So there's a lot of signs that things are weaker than we're hearing on the news. I've said this a long time, and I'm concerned about it. Does that mean we can't make money in the market? Well, probably not. I mean, if the market's being propped up and continues to be manipulated, or if Trump does some stuff and encourages the Fed to lower interest rates, print money, and continue to make this facade continue to go and provide liquidity for the markets, we can still see some upside. But the thing is, there's more and more reasons that give me caution and fear and make me more interested in saying, you know what, we really ought to dial back and start protecting money again. Maybe we did it a little too long after the crash in 22 because I didn't think that correction was done. And we probably stayed safe too long, and we've gotten in and we've made some good money this last year or so and 2 years in our growth portfolios. But maybe the gas has run out. We don't want to give the profits out. We want to always take money off the table and put our profits, or some of our profits, always take and lock in some of those profits when the market's good, and lock them into principal protected accounts that I talk about on a regular basis, and protect those assets from being gone basically in the next market correction. If we ride a roller coaster and keep going up and down and up and down, remember the roller coaster ends exactly the same level as it started, but boy, the ride was fun, right? Well, that could be the stock market. You go up and down and you end up at the same place. Well, if it's years down the road, that really didn't help your portfolio, your net worth, your income plan, your legacy plan, or any of your plan. You just had a fun ride. Well, maybe you didn't have a fun ride. Maybe you get off and go, gosh, I wish I really didn't do that. We should have just gone in this slow and steady and just kept taking profits along the way and been a little smarter. I think that's where we have to be right now is, we've had a good run this summer, and we better be cautious. Just because it's November and past Novembers have been good, I don't think is a promise or any guarantee that November is going to be a good month. It could be, but I think you need to look at all the different things that are here. And I think there's far more risk elements to the market right now than there are tailwinds pushing it forward. So enter cautiously. If you still have a little bit of fun doing it, great. Just know that what goes up can come down. And please don't put money in the market you can't afford to lose, especially right now.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about current events, what's happening in the market and the economy. You're hearing this conversation today, and you're saying to yourself, I'm not sure whether or not my portfolio is really built for times like these. If that's you, give us a call here at Premier Retirement. Request your Premier Retirement Roadmap, no cost, no obligation. The number to call to get yours, you can make that call right now, 520-780-9059, 520-780-9059. You could also find out more about us online at premret.com, premret.com. Jeff, let's continue our conversation here about current events, and let's talk about interest rate cuts. Fed Governor Cook warned that a December cut is not guaranteed, and we may not have any more cuts here the rest of the year. What is your view on that?
Well, I think, honestly, the interest rate cuts basically means government printing money in simple terms. So if the government cuts rates some more, they print money, but does it fuel the economy? Does it just help people pay off debt? Does it actually go just straight to the stock market and drive the market up, but poor people stay poor and the people that are struggling financially continue to struggle? Or is it really going to help people buy more cars, buy more houses? And if we have another 0.5% decrease, I don't know. I don't know that it will trickle into much more than the stock market, make the market happy. However, I think, if the Fed wants to make Trump happy and make sure that the market doesn't crash before the end of the year and it ends on a good note, so we can at least say the calendar year was good this year and we could deal with next year, I think there'll be a lot of pressure on the Fed to continue to drop interest rates, because interest rate drops are typically very market friendly. Not only market friendly, interest rate drops help the bond market. We've seen some rebounding in the bond market lately in the last month or two. The 20-year bond, 10-year bond are all up and starting lately to go down a little bit with the resurgence of the dollar growth and gold sell-off. But I think if we do have some more Fed cuts and the pressure, downward pressure on interest rates, that usually makes upward pressure on bond prices. They become a little more pricey, but that also usually means the market is weak. So if we see some more weakness in the market, I'm sure we're going to see some rate cuts. If we keep seeing the market go back to creating new record highs, all-time highs, and it keeps doing it on a regular basis, there really isn't a reason for dropping interest rates, because it really just overinflates the market. And unfortunately, that would just make houses, cars, and other things just as hard to continue to buy. We're already noticing, in order to offset the repos and the defaults and so forth in the credit market, we're already seeing increased rates on credit cards and stuff like that. And car financing isn't really going down because they've got to make up the difference on those that end up defaulting. So there's plenty of evidence that we know that the economy is struggling. People are having a harder time. The middle class person is having a harder time paying their bills and staying afloat, keeping their head above water for their families. But we've also seen at the same time, the rich continue to get richer. The manipulators of the market continue to manipulate and suck profits. We're seeing some shenanigans by, just setting bids and ask prices so far apart that the market makers, the banks, are making, and what that means is really the wholesale/retail price of stocks. The spread between what they would sell you a stock for and what they would buy it back from you is bigger and bigger, meaning they make more on every share of stock that goes through their wirehouses. And that's not a good thing. So, there's a lot of reasons to expect rate cuts because of the economy. But then again, you don't want to create overinflationary pressures. And if the market's already been manipulated, do you want to still fuel that fire? I don't know. So it remains to be seen. I don't really have an opinion. I'll just go with whatever happens.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about current events, what's going on in the headlines. If you're looking to position yourself and your portfolio for times like these, give us a call here at Premier Retirement. Schedule your Premier Retirement Roadmap at no cost and no obligation. Our goals at Premier Retirement are to preserve your wealth so that you can have a better retirement, create income streams that you can count on, and of course, reduce taxes with our Premier Retirement Roadmap. Again, no cost, no obligation. 520-780-9059 is the number to call to get yours. 520-780-9059. You can also find out more about us online at premret.com. Jeff, let's take a break. When we come back here on Premier Retirement, we've got listener questions, and then later on, gifting strategies when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Hogan here on 790 KNST. We really appreciate you being with us each and every week here on the radio. We're on the radio for you 4 times, actually. Saturdays at 7 a.m., also 9 a.m. and 1 p.m., and then on Sundays at 11 a.m. If you've missed any part of our program today, we've had a great conversation, but you can catch up with us on our podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so that you can stay on top of your journey towards growing your wealth and a secure retirement. Our telephone number, 520-780-9059. You can make that call right now if you'd like to request your Premier Retirement Roadmap. No cost, no obligation, no judgment. 520-780-9059. It's just a casual conversation. We're also online at premret.com. Okay, Jeff, time for listener questions. We'll kick it off with Mike listening to us in Tucson. Mike says, I'm 78 and have quite a bit of money in a mutual fund, which has done well due to the amount of tech stocks and others that have appreciated quite a lot. This fund is not in a retirement account. I fear a significant decline in the S&P in the near future. I have a considerable amount of unrealized capital gains in this fund and can't decide whether selling some or all of it and paying the taxes makes sense, or if I should wait through the coming decline. I'm 78 and retired. My wife and I have an income of $200,000 due to IRA withdrawals. What's your opinion on his situation, Jeff?
Well, it depends. Nobody likes to pay taxes, but you never get hurt taking profit either. And eventually you're going to pay taxes. Would you rather ride it through the next correction and have 20% less and still owe 20% less taxes and still have 20% less money when you're all said and done? Or would you rather just, and I'm assuming, if you have unrealized gains, they're going to be taxed at long term because mutual funds always pass on short-term capital gains because that's all the trading that they do inside the mutual fund. And they would send you a 1099 on that. I'd also be surprised, unless you've looked at the exact number, how much deferred profits there are in mutual funds. I find it to be very rare that you have a lot or what you consider quite a bit of gains that you would have to pay taxes on, because usually they have about 100% turnover. And the only thing you would have gains on is certain stocks that they might not have turnover. Maybe some of these like Palantir or Celestica and things like that are more AI driven and have gone up 300, 400, 500%. And maybe they haven't traded out of them or rebalanced them. So there may be some in tech, and I get that. But there's so much trading going on, unless those are big positions, I'm surprised you'd have maybe even half of those gains still taxable. But nevertheless, I get it. It's a big deal. The thing is, anytime you pay taxes, it's because you made money. And most of those taxes, I believe, would be coming out as long-term capital gains, not short-term capital gains, which means you're going to max out at your income. You're not even going to max out at the 20% tax bracket, likely be the 15. You have about $200,000 in gains before that happens and still stay in the 24% tax bracket on your income. So, you're still in the 22 bracket, then you'd end up having most of that capital gains would be about 15%. In my humble opinion, I'm not an accountant, but that's the way I understand the tax code. So you can double check that. We have CPAs on staff besides my son who, works in the business doing plans and planning. We have Kirsten who actually does tax returns, and we could hone it down to exactly what your tax problem would be. I don't think you should ever squirm about paying taxes if you're taking profits off the table. And I think you're right to think that a crash probably is coming. And we just saw this, earlier I was talking about a big popular stock, Palantir, that's been just going crazy. I think a year and a half ago, it was less than $10 a share. And now it's 191 as I speak, I believe 190 or something. And that's after, going soft this week when their whopping annual earnings are only 44 cents. So yeah, if you've got a stock that you can get out of that has a 400 plus price earnings ratio, it's way overpriced, and you're never going to get hurt taking profits on that stock, in my opinion, because eventually it'll probably settle into a more of a realistic value. And I don't know that they're not overvalued. Could that stock still go to 400? Maybe. But I think it has a better chance of going to 100 than it does 400 in the near term. So, and again, I'm not giving stock recommendations, or I'm not trying to use my crystal ball and guess what's happened. That's just how I would lean opinion-wise, just my opinions. And we do disclose that, I think, at the beginning and after the show. But, so I'm not making any recommendations of whether you sell or buy. But as far as considering the tax ramifications, just from a philosophical and a values-based standpoint, you never get hurt taking profits. And if you don't want to ever pay profits on those again, you could either, you could use ETFs instead of mutual funds. It's a little bit more efficient. They're always going to be long-term capital gains as long as you hold the fund a year, even with the trading that goes on inside them. So they're a little more tax efficient than a mutual fund. You don't pay as you go, but you do pay when you eventually sell them. And if you do have some ETFs that you want to hold long-term, maybe you just want a S&P or, a NASDAQ type hold where you just want to, ride it out till you die and let it step up in basis. An ETF is a much more friendly way to play. The other thing you could do is if you want to protect your principal and never have it go down, yet still be exposed to the tech markets, you can do indexed annuities and expose them to the NASDAQ or other tech markets, have some upside. If you backtest them, some of them actually backtested around double digits or more in returns with no risk, which is pretty strong. If you want to just take those profits off the table, pay taxes now, and then have a tax deferred account that you can pull taxes out of. Now, keep in mind, that would be ordinary income, but you get to pay taxes on your terms when you feel like paying taxes. And it might be that you use that money for your final expenses, healthcare, things that might be an otherwise write-off, but would keep you in a situation where your taxes would be more monitored. I think at 78, you're a little too old to consider a LERP, or I'd probably focus it on that direction, because that's where you can put your money, have the market go up and have you get gains, but in a tax-free account that never gets taxed even when you die. So for those that are listening that are curious about this question and have a similar situation that Mike has, I would consider rolling those into a LERP account, which is just like having a tax-free bank account. And I think you'll find that between the growth, this nice steady growth, the lack of risk, and the tax-free benefits, including a tax-free death benefit that could be used for long-term care, terminal illness, and other things, and still go to your heirs tax-free, and possibly, if you structure it correctly, may not even be estate taxed if you're in a big enough estate situation where that's a problem as well. So a lot of ways to skin that cat. Some are tax efficient, ways to move money into, some are less tax efficient. But from a standpoint of just protecting your assets, you never get hurt taking a profit. There's an old saying, is that pigs get fat and hogs get slaughtered, or the other way around. But anyway, right. If you want to be a pig and keep on hogging all the gains, eventually you're going to be big enough. And when the market gets so big, it sells off, you're going to feel like you got slaughtered. So don't be overly greedy. Don't be a pig or a hog. Just get out when the going's good, and you're never going to get hurt taking a profit. That's really my final word.
Mike, thanks for listening to us in Tucson. And of course, if you have further questions, call Jeff at 520-780-9059. We would love to talk to you. Next question, Jeff, is John in Rancho Vistoso. John says, I'm 58 and hoping to retire in about 7 years. Most of my savings are in my 401k, which is invested mostly in target date funds. With the market being so good lately, I'm worried about the day that it falls and corrects. Should I move some of that money into something safer or just ride it out?
Well, I think you're at the point where you don't want to write it out anymore. That's really, why we're in business and helping people take those profits off the table, just like the last caller. Thing is you're in a position at 58 and you've got target date funds, which, by the way, I think are very inefficient and typically underperform what you could do on your own. And if you were a client of ours, we'd help you with that 401k until it was able to be restructured into something more efficient through a self-directed IRA and get you into some other things. But if you're still working at your company and you have a 401k, there's probably limited things you can do. Those target date funds typically, have some bonds in them, which really haven't performed that well, but I think will probably get better. The stock market could crash, but if 60% of your money is crashing while the bonds are only getting marginally better after you've already taken a hit on bonds, you're really not going to get the bang for the buck that you were to have hoped. There's probably some short-term bond funds or some more conservative places that are not target date funds that would have less exposure to the stock market if that really worries you. And I think there's no reason why it shouldn't worry you given the state of the economy, given the state of where the market is, which is way overhyped and overvalued compared to historicals, that you ought to be concerned. That doesn't mean we still have a lot of money at play in the market, but if you're 58 and you have money that you're expecting to live on down the road, I don't think you should be risking that money. 7 years is a good term to maybe weather the storm and have a crash and have it come back maybe to where it is. Even if you look at the last two big crashes, the dot-com bubble and the banking bubble in 2008, both times the market crashed 50% and it took 7 years roughly to get back to even. So if you've got 7 years of retirement, you could just say, hey, I'm just going to ride it out and hopefully in 7 years I'm going to be where I'm at. Or if you do have access to some of that 401k money, maybe it's for prior 401k or it's stuff that's vested and they'll let you take it out. Or maybe you have to wait till next year when you're 59 and a half. I would suggest keeping as much as you need for the future as safe as you can. And when you're 59 and a half or have access to some of those funds, is to put them into something that's guaranteed to grow, not go backwards, and guaranteed to provide income. I mean, if you have $1 million and if in a year and a half you're going to be 59 and a half, or if you're almost 59 and it's less than a year away, great. Then let's say next year, you just keep your money safe where it is now. You don't lose anything on the million. You don't make anything other than what you and your employer put in. And maybe you dollar cost average into the market. And then let's say you put half that money into something that for 6 years would grow for income. There are companies that would roughly double that 500,000 to $1 million guaranteed income account, meaning the account would be worth $1 million if you were to buy an annuity anywhere, whether that account grew or not. And that's how confident some of these companies are that they can make money on your money. And let's let them put their money where their mouth is. And the bottom line is if they miss, it's not your problem. If they do better, then you actually get more income. And that income at age 65 would be probably somewhere around maybe $60,000 or $70,000 a year, even though you only put $500,000 in an account. That's way better than the 4% rule. That's better than almost any pension that I've seen. I don't know that I've seen one better if you have some time frame where you could actually wait it out. So yeah, there's a lot of options to take those profits off the table and set up an income stream so that if you did ride the market out with maybe half your money or a portion of that money, you could still maybe write it down, have it get back to even, but not need that money because you've got another fund that's going to generate the cash you need to supplement your Social Security and still pay all your bills. So again, we look at the future. We don't look backward so much. We look at the present, where you're at, what could happen. And, my biggest question is, and the reason you're probably calling in because you've listened to this show and know that we're more take your profits and guard them with your life because that's smart. Some of the people that don't do what we're talking about have never really thought of the process. Well, gee whiz, What if I lose half my money and the market doesn't come back? What would that do? Well, I'd have to work 5 more years. How would that affect you? Well, that would be sucky. I couldn't travel. I couldn't do the things I want to do. And my wife would probably be all mad at me because I risked what we worked a lifetime to achieve. And I certainly, if I did roll it out of the market at less than it's worth today, well, I'd have less income, wouldn't I? How do you feel about that? I mean, could you live with that if that turned out to be the answer or the possibility that happens? Well, if it does, then you can't live with that. Then take it off the table, remove it. Only go with the scenarios that you could live with. Like, well, the market doubled, but I only made 50%, but I didn't lose any money. Am I still okay with 50%? Yeah, I'm 50% ahead of where I was when I started this plan. Great. And I didn't lose any money. I didn't lose any sleep. I got to retire on my own terms. I got to pay my bills. I had enough and then some. Oh, but I didn't make all the market because NVIDIA went to the moon and I could have been in there. Well, you could have. You would have, could have, should have, but you could have lost money too. So bottom line is you have to think of all the scenarios and you have to take the ones that you can't live with off the table and then pick the best one within the range of what you can live with. And you can't really cry about hindsight. You have to just be happy with the fact that your plan is working, that you're not losing money, that you didn't have any of those negative scenarios take place in your life, and live a long, happy life because you never run out of money.
John, thanks for joining us in Rancho Vistoso. And again, call Jeff at 520-780-9059 if you have further questions or comments. Next question, Jeff. Ron's listening to us in Green Valley. Ron says, I'm 67 and recently retired with about $600,000 in savings plus Social Security. I've always been a very conservative investor, but I'm worried that keeping too much in cash and CDs might not keep up with inflation. I believe that's probably where $600,000 is. On the other hand, I don't want to risk losing a big chunk in the market. How can I balance safety and growth in retirement?
Well, I've talked about it for years, and it's really been the safety net and the happy place that most of my clients find, and that is in the indexed space, usually with annuities, which if you backtest almost any annuity and look at when you bought an annuity and when you could have bought a CD, I don't know an index annuity that has underperformed a CD. Now, if you bought an annuity when interest rates were 1% and it's averaging 3 or 4, that's still better than the 1% CD you could have bought back then. But yeah, you could buy a 5% CD today, but we're not talking about, whatever. But on an even keel basis, if you can buy a 5% CD today, that's because the interest rate's 5%. Well, insurance companies that offer annuities are going to make 5% on your money too. And they're able to leverage that interest to maybe make it double or triple. Just like a 1% CD 5-6 years ago could have been a 3 or 4% annuity. That's 3 or 4 times what a CD would have paid. Well, what if you can make 10 or 12 or 15% on a good rate of return on the best index type products based on the fact that you're getting in with a high interest rate? So you can beat CDs with indexed products that have principal guarantees and you won't lose a big chunk in the market. If the market crashes, the worst you can do is make 0. Well, okay, you didn't make the guaranteed interest that year on the CD, but the CD is never going to double or triple the interest that they pay either. Whereas on an index product, they can. And you're also young enough, and if you're healthy enough, you might want to consider a LIRP, a life insurance version of an annuity. And if this is $600,000 in savings that you're paying interest on, you might find that your money go a lot further and that your Social Security may not be taxed at all if you had the bulk of this in a tax-free version of an annuity that paid you income, had a death benefit that was also available for you should you go to a nursing home or need some sort of long-term care even in your home, or had some sort of a terminal illness that you could access a death benefit tax-free before you die. You don't have to die to get life insurance. You can actually call it life insurance, not death insurance, if you purchase the product and utilize some of the benefits that are available to you. And that is basically you get to spend the death benefit and the growth within that policy during your lifetime. So I would say you easily, without risking a lot, if you use the 4% rule in Wall Street and took a lot of risk, you can only pull out about $24,000, $25,000 a year to live within that 4% rule. Well, right now you can get a CD that pays that and you wouldn't even dip into principal. But will it keep up with inflation? I don't know. Well, what if you could put $500,000 in there and get $40,000 income, $15,000 higher than you can get through the 4% rule or with a CD? And that's guaranteed for life. And guess what? You've still got another 100 or 200,000 in savings. That doesn't really matter what you make. If you do get 3 or 4% or put it in CDs and make some money, then of course that'll grow. Maybe that's worth 200,000 or 300,000 more while you're living on $15,000 a year more. So you get $1,000 a month or more in income. You still have a little nest egg for emergencies. You have your long-term care covered, and you have your terminal illness and emergency funds that you can get out. And by the way, the income, if you use the LIRP version of an indexed annuity, the LIRP version is very flexible in the income. You don't have to take a set amount every month. You can set it up that way. You can set up, you just take chunks out every year when you need it. The bottom line, that will be tax-free, and your Social Security, if that's all you're receiving, would probably be tax-free as well. On the annuity side, however, you'd always pay tax on the interest you make. The same with on a CD. That may require some of your Social Security to be taxable. if you're living off interest off of that savings on the 600. So there are some more efficient ways to create an income stream if you're looking at keeping up with inflation. Social Security will keep up with inflation to a certain degree, but if you want your investments to keep up with inflation too, then it's nice to lock in the income you need and let the rest be in something that'll grow slow and steady, or maybe even you're willing to take a few risks to try to keep up with inflation over the long haul if it's money that you don't need and you have an emergency fund and savings and so forth for those what-if things that come up.
Ron, we appreciate you listening to us in Green Valley. And, of course, you can always give Jeff a call here at 520-780-9059 to further this conversation along. It's not going to cost you anything to do that. Certainly, there is no obligation. 520-780-9059. Jeff, been a great segment here. I want to remind our listeners that if you're hearing the program today, you're looking for resources to help you be a better investor. You're looking for somebody to walk alongside you as you invest and grow your wealth for retirement. Premier Retirement might be the answer for you. We're offering the Premier Retirement Roadmap right now for our loyal listeners. Absolutely no cost and no obligation whatsoever. If you want to preserve your wealth so you can have a better retirement, if you want to create an income stream that you can't outlive, if you want to reduce taxes, again, request your Premier Retirement Roadmap. Not going to cost you a dime. 520-780-9059. You can also find out more about us online at primret.com. Jeff, let's talk about gifting here. It is the month of November, and the gifting season is coming up just around the corner. So, Jeff, most people think of gifting as something that happens after they're gone, part of their estate plan, but why do you encourage people to give while they're still alive?
There's a lot of reasons. First of all, the gifting for estate tax purposes really doesn't affect the majority of people. The only reason you have to file is if you're trying to give away a ton of money to your kids so that you don't have to have estate tax on it when you die. And right now, per person, it's like roughly $14 million per individual. Next year, it'll probably be $30 million combined. So it's between $28 and $30 million if you're married that you can have in an estate and not have an estate tax. So really, the gifts are inconsequential. If you want to give $500,000 to somebody, one of your kids, to buy a house, and your estate ends up only being a few $1,000,000 when you die because you've already distributed it, you're not going to really have an estate tax or problem. You just have to declare that you gave it away. So if it's higher than $19,000 a year right now, which is $38,000 per married couple, you can gift that away. If you give more than that away and you're worried about it coming back to haunt you on an estate tax level, file a gift tax return. Say, hey, I gave this money away. If you give more than that away, it's an estate tax avoidance technique that rich people use. But most people are worried that they're somehow restricted to do that and it's going to come back and haunt them, or they have to pay tax on a gift. You don't have to pay any tax on a gift. It just comes off of your future estate tax bill or a tax exemption. So let's say you end up with a $40 million estate, but you gave $10 million away during your lifetime, but you gave it away over the next 30 years. Well, guess what? Your estate's still under the $30 million threshold, so you don't owe estate taxes. However, if they drop the estate tax level to 10 million and you gave away 10 million, they go like, oh, okay, well, if you give it away 19,000 or less, then you still get that exemption of 10 million. But what if you don't? What if you give it away in just one big old lump sum? Well, then it actually comes off your estate tax exemption. So if the estate tax exemption is 10 million, you end up dying with 10 million, but you gave away 10 in a lump sum. Guess what? You owe estate tax on that 10 million because you tried to jimmy the system because you still had 10 million. So you end up paying tax on all 10 million because your estate tax exemption is zero. You already used it. So I don't know if that was a convoluted example. It really will only affect high net worth individuals that are worth tens of millions of dollars or expect to be worth tens of millions of dollars in the future, unless they drastically reduce the estate tax or the unified credits, the estate tax exemptions. So again, that's one reason to gift. If you have an estate tax problem, you can kind of do what we call estate freezing. Now, if you don't want to give that money away and have all your kids spend or squander it, you can actually set it out aside from your estate in like an irrevocable life insurance trust where you buy a big fat life insurance policy with those $19,000 gifts to all the heirs you want to. Maybe you have 20 of them, and so you can give away $380,000 a year, and you've got tens of millions of dollars, or maybe just 10 million or more. You just don't want your estate to grow because you're worried that they're going to lower the estate tax exemption in a few years. Well, you could give your kids that money, let them refuse the gift, and then put it in an ILET and end up giving them maybe $20 or $30 million in a death benefit through a life insurance policy outside of the estate that is not only tax-free income to the kids, it's also estate tax-free. And by the way, you don't have to have tens of millions to do this. You could actually do estate planning where instead of giving those gifts directly to your kids if they don't need them, now is to give them a tax-free death benefit, maybe depending on your ages, or you can even do this where grandkids are the beneficiaries, to where maybe they receive that money tax-free in a time of their life around the time that your life expectancy would be, to where they would benefit most. with a tax-free death benefit, or that gift coming back tax-free and estate tax-free, so that you get to pass on the entire estate, not just a portion of it. So what other reasons are there to gift money? Well, a lot of people like to gift money while their kids are alive so they can see them enjoy it and see them spend it, rather than be dead and leave them a big fat chunk of money that they can do some nice things with. That might be part of it. But what if you could start gifting money now and help them put a kid through college, or help them pay a down payment on a house, or help them even buy a bigger car? I mean, we helped our kids buy a Suburban because they have 5 kids and they weren't fitting into their minivan again. So, I mean, happy to help. Okay, so it comes off their inheritance. So what? I'd rather see them spend and enjoy it now. They're not going to need a Suburban when they're 60 and I'm 80 or 90 or whatever. So, that's another reason to gift. The other thing is if it comes to gifting, not just to your children, but to gift to charities, charitable gifts are a way to keep your taxes in check. And one of the cool things to do once you're after the age of 70 is you can give charitable gifts directly to a charity from your IRAs. It would count against any required minimum distributions, which right now start at age 73, but you can still give these direct contributions from your IRAs and qualified plans directly to charity. The reason you want to do that is it doesn't use up the unified credit, which right now is at $30,000. So you can have $30,000 worth of deductions and not get any benefit from those deductions, because you get $30,000 written off the top of your income anyway. So why not get an extra deduction rather than having that IRA money come into your account, get taxed on it, and then get a $30,000 deduction? Why not give that charitable gift or pay your tithing to your church or whatever with an IRA contribution direct to them? It never comes to you on a 1099. It would satisfy your charitable contribution that you like to give to your church, charity, or whatever, and you still get the $30,000 standard unified credit that a couple would get, or $15,000 if you're single. And then when it comes time for your required minimum distributions, it also counts against that as well. And you can give directly to any charity up to $100,000. And if you want to maybe prepay all your tithing or charitable contributions early, you could front end load some of those contributions direct, not have it count as income to you, $100,000 a year, till you dial down the balances on those qualified accounts to where they're not going to put you in a higher taxable bracket when you pull that money out later, or leave your kids a big taxable inheritance when you die 10 years later, 20 years later, 30 years later, whatever. So there's a lot of implications on planning with gifting, not just to your kids, not just as a legacy, not just as a living legacy versus a dying legacy, whether it be estate tax issues, taxable issues, charitable issues. And bottom line is, it's what you keep that matters, and where it ends up with the least amount of taxes taken off the top is really what our focus is. And there's so many ways to skin that cat. It's worth spending some time on for sure.
Jeff, great conversation. If our listeners do have questions about gifting while you're live and kicking, call us here at Premier Retirement. We'd love to talk to you. 520-780-9059. We may have some good strategies for you that will help you understand how to gift while you're still alive and while you can still see the benefit that it brings. 520-780-9059 or online at primrat.com. Jeff, we're out of time for this week. Thank you so much for your time, but certainly I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. Talk to you next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.